Well, do you think Medicare is free once you hit 65? If your income's too high, there's this hidden surcharge that can actually kind of quietly shrink your Social Security checks. Could be by potentially thousands of dollars per year. It's called IRMAA, and we're going to talk about IRMAA, not a person, but something that happens to your finances on today's show so that you know that it's coming and know what to do about it. I'll grab Phil and we'll get started.
Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show.
Welcome back to Phil's Tax Hacks and Other Retirement Facts. I'm Walter Storholt, filling in for Mark Killian today, but excited as always to have the chance to talk with Phil Putney about what's happening in retirement, finances, and IRMAA is our topic today, Phil, and I'm looking forward to diving into this with you.
Our Aunt Irma.
Yes, that's the joke, right?
Say we've got Uncle Sam and Aunt Irma. So
I don't know which one I want to see less, but maybe we'll have a clearer answer
that's
of that
your
by
favorite aunt and uncle. So.
That's right. Well, let's talk a little bit about IRMAA and what is this? Why does it exist? Give us a little bit of a history or some foundation on this thing.
Yeah, I mean, it started in 2003, and it's kind of think of it like a means testing for Medicare. Right. So for most individuals, Medicare Part B, there is a fixed premium. Part A, you've already paid for. That was withheld from your paycheck all your working career. But Part B and then Part D for prescriptions, you have to pay for. And it's a fixed number each year, and it does go up with inflation. But then if your income, modified adjusted gross income, is above a certain threshold, then it starts to cost you more. So the first tier is an extra 40%. Then it goes up to like 200 or 340%. So, I mean, it's a pretty significant, potentially increase in your Medicare premium. But the good thing is it gets reset every year. So,
okay. So this isn't really a penalty, but kind of feels like one to many people. Is that a good way to kind of look at it?
Yeah. I mean, technically, it's not really a penalty. Frankly, I refer to it as a tax, because to me, it walks and talks kind of like a tax. It's
penalty
based on
tax,
Yeah, I mean, the more you make, the more you pay. So it's just another hidden tax out there.
Makes sense.
But yeah, I mean, it's something you want to definitely be aware of because you don't want to get hit, blindsided with it one year.
Yeah.
Thinking that you're going to pay, for instance, this year, the base premium's $185.
Okay. Let's dive into those numbers a little bit. Sure. And we're going to put a graphic up on the screen for our YouTube audience. But who's most at risk of paying IRMAA and kind of break that down for us a little bit so we know, should we be on the lookout for this or not?
Sure. Yeah. So for single filers, once you hit 106,000 of modified adjusted gross income, married is double that, so 212. Then you hit that first tier. And the kind of the strange thing with the IRMAA calculation is for instance, 2025, it's based on the 23 numbers. Okay. And the reason that's the case is that Medicare premiums are announced typically in the September or October, probably timeframe, late September, early October each year. Well, at that point, for instance, this year, 2025, we'll find out 26 premiums here in another month. Well, right now, the only thing we know is 2024. That's the latest tax return filed. So that's kind of the thought process behind it. But it gets recalculated every year. So 2020 coming up, 6 premiums are going to be based on what your modified adjusted gross income was in 2024. So it does get recalculated. You don't have to worry about kind of getting stuck in a certain place. But, who's most at risk is going to be, if you're still working, both of you and a spouse, you have a lot higher income. Definitely could be at risk if you have these one-time events. You sell a business, frankly, retirees, this is something we work with all the time, helping project down the road is once you get to RMD ages, you're going to get forced to start taking these additional distributions from your IRA. So sometimes that can push you into these higher levels of IRMAA, or if there's like large capital gain distributions. So anything that generates an additional income stream, taxable income, part of your modified adjusted gross income, then it's potentially going to put you at risk for that year But again, what happens, for instance, in 25, that's not going to affect your premium until 2027.
Gotcha. It's interesting that it's staggered the 2 years, unlike a lot of other tax things, right?
Right.
Okay.
Yeah, I mean, it's all just based on what they know at that time and, that point in time. So,
Makes sense. So, how big of a deal is this? Is this something that's just scratching the surface of people's retirement plans, or a little bit bigger issue and deal for folks? I teased obviously at the beginning of the show that it could cost somebody thousands of dollars a year. So that sounds like not a small deal to me.
no, it's not a small deal. I mean, it can be pretty substantial. So, I mean, it starts out at 40%. It's an extra 40%. So it'd be for this year, an extra $74 per person.
Okay.
If you hit that top tier of IRMAA, which this year the top tier of IRMAA for married starts at $499, or I'm sorry, single is $499, 500,000. Married is $750. So I mean, it's a pretty substantial adjusted gross income. You have to have something significant happen in that year to hit those for most people. But at that tier, now your premium is an additional $443 or $444 per person. So that could be an additional $5,000 per person. And then your Part D is going to be at the lowest end, $13.70 more a month, up to $85.80. So again, if you hit the top tier, it could be another $1,029. So it can be
all said
pretty
and done,
significant.
6,000 plus for those, higher bracket earners, and then per person, you got to keep
That's
that in
per
mind.
person. So now you're at 12 grand more. So that's another $1,000 a month for Medicare. If again you hit that top tier.
Okay.
And this is something that it just like your Medicare premium, as long as you file for Social Security, you're not going to get the bill. It's just going to reduce your check. So if this happens prior to you filing for Social Security, then yeah, it will increase your quarterly bill that you receive from the Social Security Administration.
Okay. So as I understand it, there are certain things that trigger IRMAA and others things that do not. Can you help us understand the difference between those?
Yeah, so really it's the modified adjusted gross income is everything that comes into your adjusted gross income. So think of it like the front page of the tax return. So your RMDs, capital gains, stock options, if you've exercised those, business property sales. The one thing that isn't on the front page, or at least in the taxable column, is tax exempt bond interest. So that's kind of the modification to adjusted gross income. Pension lump sums, there's a lot of different, anything that's income, interest, dividends, pension, Social Security, IRA distributions, all of the above. So those are everything that would trigger. What doesn't is going to be Roth IRA withdrawals. So there, again, is some of the planning we look at clients with is kind of planning down the road if you're going to have these large required minimum distributions that can force you into a higher tier. It may make sense, hopefully prior to Medicare, to start doing some conversions and, reduce that IRA so that in the future now we don't have these larger RMDs. So it's just much more control.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
Well, you kind of hit on a little bit there. My kind of last question, I guess, is do we just absorb this impact from Aunt Irma? She packs a strong punch, or can we dodge? Can we move? Can we bob and weave and maybe use some strategies to lower this impact in this issue?
Yeah, I mean, there's definitely planning that can be done around it. And it's something that we work with clients on all the time. Like I mentioned in the beginning, I look at it as an additional tax. So it's one of those things that you have to be aware that it's there, what the tiers are. The tiers do get indexed for inflation each year, so much like the tax brackets. Which is relatively new. It didn't used to have an indexing, so you could get pushed into those tiers pretty quickly. But yeah, it's becoming aware that these do exist, looking down the road to see, okay, once I hit, if I'm maximizing Social Security, I hit the RMD age, I've got pension, whatever it is, that maximum retirement income that I might hit at some point in retirement, does that put me into the IRMAA tier? And if it does, then it might make sense to start looking ahead to plan, much like Roth conversions and the taxes. And another key point to consider too, when you're looking at IRMAA, again, much like we see from a tax scenario where the brackets for a single filer are half what they are for married. So very often we see where maybe a married couple throughout their retirement, they do not have IRMAA, but when either spouse passes, the surviving spouse is now single. They generally have typical income. They've lost half, not half necessarily, but one of the Social Security benefits, the lowest. So there is a little bit lower income, but probably not half. So they could, as a surviving spouse, now start to get pushed into those IRMAA tiers, or maybe even, if they're in it, higher up those brackets. So again, part of that planning and looking down the road, just like we do for taxes, and the same thing happens from a tax standpoint. You go from married filing joint to single. So
yeah,
again, something to consider.
So if you are going through a big life change, or if you haven't put together a financial plan before and you don't even know what this IRMAA thing was until we started talking about it 10 minutes ago, or if you're even working with an advisor currently and they haven't talked to you about IRMAA, that hasn't come up as part of your conversations, that might be a reason to get a second opinion and reach out as well. Make sure that this is something you're discussing with your advisor, because even well-prepared retirees can get caught by surprises like this. This is one of those things that's not as well publicized out there in the financial world that can impact your bottom line and those dollars in retirement. So make sure you're discussing that with your advisor. And as always, if you want to talk to Phil a little bit more about the specifics of your financial and retirement plan, you can do that very easily. We've got contact information on the screen. If you're watching on YouTube, you can go to philstaxhacks.com. We've got that linked in the description for you as well. For more information, you can find links to book a complimentary review of your portfolio with Phil and much more as well. So definitely check out those resources in the description of today's show. Phil, any final thoughts on IRMAA?
Mm-hmm. Yeah, one more quick thing.
Sure.
So you mentioned life-changing events, because that is one of the exceptions. So if you have had a life-changing event, so marriage, divorce, death of a spouse, work stoppage, so you retired, or work reduction. You went from full-time down to part-time. So if you've had something like that, and there's 3 or 4 other ones, but if they're pretty narrow. If you've had a life-changing event where, retirement's the most common, if you retire and they're going to look back 2 years, well, all of a sudden, that might be maybe a higher earning year where technically it would calculate and put you in IRMAA. You can file, it's a form SSA 44, where you can tell the Social Security Administration that you've had one of these events, and then tell them what you anticipate your income to be in the current year. And then they won't look back 2 years. They'll actually look at and use the numbers you've given them. Okay. So it is kind of I want to say one time. It can happen multiple times if you've had any of these life-changing events, but it's only in the event of one of these type of activities. So, and the other thing to keep in mind when that happens and you file that, make sure it's somewhat accurate. Don't underestimate too much your income, because they will check the math. So I mean, if you told them, oh no, my income is going to be $200,000, I'm below that IRMAA tier, and then you decide to do Roth conversions, and now your income's at $300,000. Well, once the return gets filed and they realize that, they will come back and check. You'll get a nice little reminder that, oh, by the way, you did hit the tier. Here's the IRMAA, and they'll withhold that from your Social Security benefits. So,
okay, great clarification. I know this is one of those things if you're a DIYer, this is one of those areas that's a little complex and hard to navigate through all the hoops and figure it all out. So glad we have you to lean on, Phil, for these kinds of things. Quick reminder, you can touch base with Phil. If you're new to the channel, by the way, Phil is a CPA as well as a personal financial specialist, AFS Wealth Management. Again, check him out online at philstaxhacks.com. Contact information and more resources linked in the description of today's show. If you're watching on YouTube, don't forget to hit like and subscribe so you don't miss future episodes. And Phil, thanks for all the great details today. Appreciate it.
Thanks. Have a great day.
We'll see everybody next time right back here on Phil's Tax Hacks and Other Retirement Facts.
Phil? investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.